What's going on, Hot Take Nation? DRW here. Before we start this week's episode, I wanted to let you know it's being brought to you by a friend of the show, the Kuiper Law Firm, which is, not my word, but true, a multi-jurisdictional, full-service oil and gas law firm with offices in Houston, Denver, Dallas, Midland, Oklahoma City, and Lafayette. The firm is licensed to practice across most producing states, retains significant experience in every producing basin, and provides skillful representation across a wide variety of matters, including title examination, regulatory representation, acquisitions and divestitures, contract review, midstream dedication, and many other aspects of onshore natural gas and oil development. The Kuiper Law Firm strives to create an effective, efficient, personable representation by attorneys that understand and know the oil and gas industry. And every once in a while, they may take a LinkedIn banning case. Not always, but if they're a friend of the show, they'll definitely do it. Not only does their firm have extensive experience representing the industry operators and participants, but most of Kuiper's attorneys began their careers employed by operators. This hands-on experience allows the delivery of legal services that are truly effective and efficient for their oil and gas clients. Though the difficult market presented in the past few years has been tough, the Kuiper Law Firm remains committed to serving oil and gas clients. Alex Kuiper founded the Kuiper Law Firm with a vision of accessible expertise, efficient and quick service, and a client base revered as friends. I can attest to this. Recognizing the many hardships on industry professionals today, the firm actively participates in free educational events available to all, welcomes questions from industry's professionals that they address in their blog, and is available to all clients and non for guidance in these challenging times. So, thanks to the Kuiper Law Firm for sponsoring this week's episode, and on with the show. What is going on, Hot Take Nation? It is DRW here for another episode of the Hot Take of the Day podcast. I believe we're at about 85, which is a pretty prolific pace for 2020, given everything that has had happen. This week on the show, I have Joe Mills, who is President and CEO of Samson Resources. I got the title right. It's President and CEO, correct?
Correct. Yes. Thank you.
Well, welcome to the show, Joe. How are you?
Well, thank you, David. I appreciate it. I'm doing well, doing actually very well, considering, the world we're living in. I'm actually doing pretty well.
It is a crazy world. I was thinking back. So the last time we had a show that we talked about the Powder River Basin was episode 8, and it was with Joe Dominic of Anschutz, who I know you know. We were talking a lot about technology in Wyoming and fracking and different plays. And at the time, oil was 50-ish. And had come off of 62 because of the assassination of the Iranian general. The Australian bushfires were raging, and there was this small thing coming out of China that no one really appreciated what it was, this coronavirus. Now flash forward to November, and things are totally different. Why don't we start with just a high-level overview of Samson and the position that you guys have assembled and how you got it up in the Powder River Basin, and we'll go from there.
Great. Thank you. Yeah, I'm happy to. Well, first off, David, again, thank you. I appreciate you guys, hosting me, and this is fun. Wow. When you talk to Joe D, that was 100 years ago, how the world has changed for all of us. But fortunately, we at Samson are doing actually quite well. And so a little bit about the Samson story, and I always have to kind of explain, there are really 3 Samsons out there. So mine is Samson Resources, kind of the original legacy Samson that was started by Charles Schusterman back in 1971. So, we're approaching our 50th anniversary of being here based in Tulsa, Oklahoma. Today we're a much smaller company than we were. There are 2 other Samsons out there, Samson Energy, which is actually the Schusterman family Samson. No relationship, no cross ownership. We have no affiliation with them. Certainly respect them, but I get a lot of calls if, we and they are the same, and the answer is we're not. So we have about 132,000 net acres across the basin, producing kind of 7,000 to 8,000 BOE a day. We're really excited about the basin. We're running a rig. Actually, one of the few. I think there's only two operators running rigs in the PRB right now, and we're one of them. But we love the basin, love Wyoming. Yes, we are on federal lands, which we'll talk about. That has its pluses and minuses, obviously now with a new administration coming in. But nonetheless, we love the PRB. I think there's a lot of upside. It's a great place to operate, in the state of Wyoming. So we're proud to call it home now.
So I don't want to go super deep in the story, but I mean, Samson, as you said, has a long history. You're about to celebrate your 50th anniversary. What year was it that was there not a big private equity reverse takeover at about the same time as El Paso is what my recollection was. And again, all the years are running together, but was that a 2012, 2013 time frame?
Yeah, 2000. Yeah, so December 2011, the company, or the Schusterman, sold Samson Resources to a group really led by KKR, which, of course, the company has always been a private company, and so we're still private today. They then went out and issued a bunch of public debt, and of course, got in trouble and ultimately ended up in bankruptcy. But yes, that was the 2011 timeframe.
When you think back to 2011 and you compare the overlay of the industry then, and one of the things a lot of people talk about is, what are we going to do about young people entering the industry? I was 20 years in, so I saw 2000 when there were no jobs and I graduated. Then I saw the run up in 2006 for gas, 2008 for oil, and sort of happened to put my career in the resurgence of oil and gas. But, from an 85 to really 2000, I know a lot of people in Denver, as an example, went to do other things before coming back to the industry. So when you compare and contrast sort of 2011 and the state of the industry then and the training programs for young people, and then you think about today for both existing staff but for future, how do we bridge that gap for millennials and young people entering the industry?
Yeah, that's a great question, David, and one that I do, worry about and think about. So, I've been doing this a lot longer than you, so I'm on my 39th year in this business, and, started out in 82, and of course, so I've been through many crashes, many cycles, 86, 92, 98, 2001, 2008, 2015, and of course now 2020. The one thing I'll tell you is that, I couldn't be more proud of our industry, notwithstanding kind of the challenges we're going through right now. Every day I wake up and I thank God that I did what I did. I mean, I love what I do. Love this industry. I mean, what we do for America and the world is unparalleled. Notwithstanding what, obviously a lot of people think we're bad people, but that's far from the case. But I think our biggest challenge is people. After the 1986 crash, and again, I was there. I was a young landman at the time. We saw a gap from 86 until about 1990. The enrollment at all the various big colleges, whether it's Texas A&M or Texas or Penn State, big PE programs, we saw enrollment really, really fall. And we're seeing that today. So, I'm approaching, I'm 60 and approaching kind of the zenith of my career, retiring probably in the next 5 to 10 years. But there's a gap behind me. That we just didn't see any young people come into our industry kind of from that 86 to 90. And then I think we're seeing that now as well. So there'll be a gap in our workforce that we won't see until 20 years from now. And that's a real concern. And so to your point, obviously 2011, 12, 13, we saw a really nice boom, and obviously saw a lot of young kids come into the space. And what I tell young people is what we do is super exciting, right? I mean, it's a highly technical business, world, geopolitics are involved. It's fun, but it is a cyclical business. It's not for the faint at heart, but we need young people. Now, one of the things I've always professed is that we as an industry are kind of slow adopters of technology, right? We've seen that. That's not to say that we're resistant to it. We're just slow adopters. I think that's changed. We're starting to be much more, almost by default, we're having to accept new technologies, right, in order to really survive. And that's not a bad thing. But what that also means is that it's probably more of a jobless recovery. I don't think we'll hire back a lot of the people that have left. But it doesn't change the dynamic that we need new young people coming into our industry, right? They're more adept to the new technologies that we're adopting, and they'll help accelerate that adoption rate as we go forward. So I'm very involved with my alma maters, University of Texas and the University of Houston, in helping trying to get young kids to continue to come into our industry. I think that really remains one of the biggest challenges that we're going to face as an industry. I've said for the past 30 or 40 years, we're not running out of oil and gas. Now, to be truthful, I didn't see the shales. I always believed that we would go drill deeper and continue to find oil and gas. I never worried about running out of oil and gas. I did worry about running out of people, running out of highly qualified technical people, because our industry is a very technical industry. So we need, continued young people, geologists, engineers, land, finance, to come into our industry, and we have to make it attractive to them. That's a challenge, and I think, but our industry is resilient, and we will survive this.
So let's talk about technology, because I think you make a really good point around, our industry has been slow adapters of technology. And whenever technology startups come and talk to me about, the new whizzy bang software they're building to integrate everything, I always say that Excel is pretty good. Now, it doesn't integrate and it doesn't, but I'm curious, as you think about technology since 2011 and moving to 2020, what have you guys embraced, and what do you see in the next 3 or 4 years that you think that you'll continue to embrace as you carry on this energy journey?
Yeah, no, great question. I'll kind of break it down into, the field. Obviously, one of the big breakthroughs for us is the adoption of hydraulic fracturing with horizontal drilling. Right? I mean, hydraulic fracturing has been around for 50, 60 years. I think back in the 30s, when they were using nitroglycerin, right, to quote, frack wells. So it isn't like fracking is new. It's the application that's new. Applying it to horizontal drilling, that's really been the game changer for us and really opening up the shale plays. So that technology will continue. Bit technologies will continue. And so again, all of us have been learning how to do things better, faster, cheaper. Where I think the game changer will be is in the machine learning, right? And now I'm really quick to point out, we all know garbage in, garbage out, right? So, the data you put in is only as good as the data you're going to get out, or vice versa. And so it still takes highly qualified people to think about or to make sure that the data that's going in makes sense. And so while we at Samson have also started to use machine learning, I don't want to use AI because we're not quite there, but we definitely are using machine learning as a way to kind of quickly analyze our basin and the statistics around it. But something you said earlier, Excel's pretty damn good. One of the things that I have, when I was with like Sonat and El Paso, really, really large companies, we had large departments and software designers, and they wanted to build the perfect beast, right? And I used to always argue, we are oil and gas companies. We're not software companies. The money and the time it took for us to build these software programs internally, by the time we actually rolled them out, they were already obsolete. They were already obsolete. That is not what we should be doing as an industry. So look, there's a lot of smart people sitting in Silicon Valley that have programs that can be adapted to what we do. Yes, we need to work with them collaboratively, that they can help us, design what we need, but ultimately let them do that work, right? We don't need to be the designers of that software. Now, that doesn't mean, Halliburton and Schlumberger, sure, those guys, they need to pioneer some of that. But I'm a big believer, especially as a small company, take what's already on the shelf and then use it, adapt it to what you're already doing, rather than, here at Samson, we had a pretty large software design group when I first took over, spending a lot of money, and they had some pretty cool software. But what I found was the cost of it, to administer it, to implement it, far outweighed the benefit as we got smaller and smaller. So we've moved away from that, and we now pretty much buy things off the shelf. Yes, we'll tweak it for our needs, but I think that's all we really need to do, because the technology changes so fast now that, to sit here, like I said, design something, it becomes obsolete by the time you roll it out 2 years later.
Talk to me about the machine learning, because I think that's a really interesting concept. Even coming into 2020, well spacing, parent-child. If you remember Q4, it was all the news, and Bloomberg had picked up articles on it. TPH had put out a study in the Delaware Basin and the Midland Basin talking about parent-child and the level of degradation. Do you think that machine learning in and of itself could have prevented that, given, the interplay between, management desires, shareholder returns, biases around recovery factors that we don't maybe understand, and then this overlay of machine learning? How do you think that machine learning will help us evolve our spacing model and decisions in the coming years?
Yeah, that's a great question. So I'll quickly answer the first question, which is, do I think machine learning, had we adopted it earlier, could have prevented kind of the train wreck? No. Unfortunately, as we find, and we're using machine learning, and not to give a sales pitch, but we're using Transform, which is an Innovis product, and it's pretty good. Again, it's off the shelf, it's got its limitations, but we find it's pretty good for what we need. And one of our challenges where we're applying it is in the Niobrara. So I have said this publicly. I mean, look, the Powder River Basin is a great basin. It's kind of a mini Permian Basin, right? We have 5,000 feet of stacked pays. We have two unconventional reservoirs, the source rock, the Niobrara and the Mowry. The Niobrara tends to be oilier. The Mowry tends to be a little gassier. But you got a lot of stacked pay, right? I mean, everything from the Parkman, really shallow, all the way down into the deeper muddy formations. Today, the formations that we're targeting are the Shannon, the Frontier Turner, Niobrara, and the Mowry. And eventually we'll also target the Muddy, which is right below the Mowry. It's an oil basin, so there's a lot of gas. Now, granted, we're in the Rockies, so gas prices doesn't really help us. The differentials are too strong, so we don't chase gas. We're very much an oil company, but we're using machine learning to try and kind of decipher the Niobrara, and exactly to what you're talking about. The good news for us in the Powder River Basin is that while we look and smell like the Permian, we're obviously a lot smaller. It's been an overlooked basin. And so we haven't had the mistakes. We're learning from the mistakes that other basins have made, right? So again, the good news for Samson, we were a big East Texas Haynesville player. We're a really big Mid-Con player. So, we chased the Woodford and Mississippian. And so we have a lot of learnings here about those reservoirs and the overdevelopment of those reservoirs, i.e. the child-parent syndrome. We clearly are seeing the parent-child syndrome in the Powder River Basin. In fact, we are now really carefully spacing our wells. The bigger issue that we run into is the timing of the drilling, right? So what we have found is that if you drill the parent well and you wait more than a year to drill the child well, you really kill the economics of both the child and the parent if you don't drill it within a certain window of opportunity. Now, that's always hard to do because of economics, right? I mean, oil prices go up and down, and so I know one of the things we will talk about is hedging, and I'm a big believer in hedging. As you probably know, I ran a very large MLP called Eagle Rock. And of course, it was a midstream, upstream hybrid. But part of the whole MLP story was you hedge and you hedge and you hedge as far out as you could so you could protect your distributable cash flow. Well, I adopted that same methodology when I came to Samson. I convinced my board coming in that hedging is a good thing. Hedging is an insurance policy. You want to protect your downside. Obviously, we're not a public company, so I don't have to worry about necessarily always the quarterly earnings calls. I've run plenty of public companies, and I'm glad to be running a private company. But, we make decisions that add long-term value, and hedging is part of that decision-making strategy. So we do hedge as a way to protect our downside and to protect our drilling economics. And so, like this year, we are literally 95% hedged at $60 a barrel. So yes, while I feel the pain of the downturn, we at Samson are fine. Our economics are fine. So we've used that as part of our arsenal to program drill and use machine learning to really help us figure out the right spacing and the timing around that spacing, because that's really critical, is the timing. Like I said, you wait a year or two, then you basically have killed. I mean, sure, $80 oil will help solve that problem, but I don't run my company, any of my companies, hoping that oil and gas prices will go up. I mean, if any CEO is running his company hoping that oil prices are going to run up, then he shouldn't be running that company.
I love, there's so many threads there, and I was going to go down the overlooked basin, and I'm going to come back to that because so 90% hedged at $60. I mean, I think that you should be applauded and the board should be applauded in terms of what governance is and what decision making is. You knew the price that was required to do a thing, and it could have been 70 and it could have been 50 in a normal world, and you elected to hedge. So I commend you for that. I think a lot of companies really missed that. I'm curious, when oil was 20 and when oil was 15, how you thought about the concept of, could you monetize those hedges for cash and then make decisions based on the strip, but then sort of use that to whether pay down debt or roll some hedges? What kind of availability was there to liquidate hedges in that crazy April, May timeframe? And then we'll go back.
That's an excellent question. Yeah, trust me, we definitely looked at it. Our hedge book, so when oil got down to 25, our hedge book was worth over $55 million, and we could have monetized it. I spoke to the board at length about it. Look, I've been doing this almost 40 years. I've seen so many cycles. Did I believe that we were going to sit in a $25 oil world forever? No. I knew prices would rally. Will it get back to 50 or 60? Sure. It may be a couple of years. So one of the things I convinced my board is that we should not unwind those hedges, right? We're in this for a longer haul. I want steady results. Sure. The other benefit that we had is that we had basically had no debt. And that's the other thing. So we have been very judicious about managing our capital structure. I've been a part of this industry a long time. I've been a part of a lot of successful companies, Sonat and El Paso, but both of those companies got in trouble because they took on too much debt. And that seems, it's a symptom of our industry, right? Production growth at any cost was always the mantra. Wall Street rewarded us for that. What was net income? Our industry couldn't even spell net income, right? And I've always been a little contrarian in that regard. I've always said, look, I run my personal business the same way, right? I don't take on excess debt just for the sake of it. So we've been very judicious at Samson about how we manage our capital structure. Yes, we use debt, but we don't over-lever the company. And so for that reason, we were very fortunate that when things went sideways earlier this year, our hedge book, we were massively hedged. I mean, for example, next year, we're 85% of our production's hedged at $49 a barrel. And that's good enough for us to keep drilling. Our economics, really at 45, we're in the money. Actually, in some of our plays at $38 a barrel, we're generating a positive return, like in our Turner and our Shannon programs. So we can continue. That's why we're still drilling today. But so our debt was such that monetizing the hedges didn't make a whole lot of sense, because then we just have a bunch of cash sitting on our balance sheet. So we opted not to. It was tempting. Trust me, it was tempting. My banks probably wouldn't have appreciated us doing it, but in the end, given our debt was really minimal, there was really no reason to do it, and I'm glad we didn't. It really provides a very stable cash flow profile for us as we've navigated these ups and downs, and that's really important to me. That, to me, has been more of a driver, and my investors have appreciated it, is that we've been able to generate, free cash flow, positive earnings every year. We've had positive net income since 2017. Every single year, and that's important to me.
So the thing that you said before the hedging that I wanted to unpack is a really interesting concept about the Powder River Basin. Obviously, One Energy was in the Permian Basin. One of the things I loved about the Delaware Basin, and in particular New Mexico, was there weren't a lot of parent-child. And so you could make a spacing call based on everything else. And we weren't moving that fast for what we had for our land. Powder River Basin seems the same in that regard, in that you can learn from your peers to say, okay, this should be 2 wells per spacing unit, this should be 4, this should be 6. But at the flip side, there was 20 or 30 rigs, as I recall, running in Wyoming. So they started a whole bunch of fires, and having to come back within a year to offset that, and now there's 2 rigs in the basin going. How do you balance? Does that mean that you'll space wells wider? If you can't get there for a year, will you space wells wider and then really focus on the high grade? Or how do you balance that pace versus spacing?
Well, that is an excellent question. Well, again, so the basin was overlooked. That's kind of a benefit, right? So we've had the benefit of seeing what's worked in the Permian, what's worked in the Mid-Con, what's worked in the Haynesville, and then using that or adapting that here in the powder. A. B, I'm always proud to say we're in a great neighborhood, right? So we're surrounded, EOG, Oxy, Devon are all neighbors of ours. And so obviously a lot bigger, stronger balance sheets. And they have the wherewithal where they can afford to do some of these downspacing tests to see how it works. And so God bless them. We've seen, they've tested 8 wells per Niobrara in some cases. And so, those results are still a little bit early. Our view is that's spaced too tightly for even the Niobrara. Now, again, a lot of it's price, right? I mean, look, at $80 a barrel, everything works, right? At $30 a barrel, well, not much works. So, a little bit of it, but when I look at it just on a pure reservoir, what is the optimal spacing? We think 4 to 6, depending on price, but probably 4 is the right answer for the Niobrara. Maybe 6, again, if you're in the $50 to $60 oil world. But the timing of that is critical. So, if you could do this the right way, you would drill all parent and all child wells simultaneously, right? I mean, you would literally line up 50 rigs and drill every location you had all at the same time, bring them all on together. Well, obviously that's not feasible, both from a capital standpoint and availability. So what we've done is we have very carefully tried to time out our parent-child wells, meaning we drill the parent and the child basically simultaneously or, back to back to try and avoid that issue. Now, if you look at our position, it's pretty contiguous. So, you just can't physically do that, drill every child well. And so that's been a little bit of, ironically, we literally right now are going through kind of a Rubik's Cube and using machine learning to help map out our 21, 22, 23, 24 drilling program. And it's heavily weighted toward the child development, right? How we space is we've drilled a number of parents and now we got to come back and drill those childs. And how the timing of how we do that is critical. I overlay that, which is a little bit unique for us. Obviously, winter drilling is never fun up here, right? I mean, we try and avoid, so we do what we call seasonal drilling, where we drill basically up until about December, and then we'll let the rig go and then pick it back up in the March, April timeframe. We also have what's called stiff windows up here, which are, of course, environmental restrictions that we have to be, we have to work around. Raptor nests, the sage grouse. So you have to, so again, machine learning helps us because there's a number of variables that we have to account for, not just reservoir depletion, but the timing of, when a stick window opens or when it closes and winter drilling. And so, so I mean, Excel only goes so far, but when you have multiple variables that you're trying to account for, that's where machine learning really, really benefits us.
So I don't want to put you in a position where you have to second guess some of the CEO peers of yours, and certainly outside of the Powder River Basin. But we have this phenomenon where we've continued to drill at a fairly high pace relative, and the duck count across the United States has been climbing. Now, there's debate on the EIA as to whether, the duck count, what's the exact number? I always use it as a relative number, and I think as a relative number, it's reasonable, and the duck count is growing. I personally was surprised that companies didn't spend this year effectively running 0 rigs except where absolutely necessary, and then clear the inventory of their ducks, because whether they're spaced properly or not, you're kind of pot committed. I'm curious if as a CEO and as you manage your capital balance sheet, are you surprised by that as well? And do you think that there will be a time when drilling will really back off to have the duck inventory clear out in 2021 to help enhance economics? Or how do you think about that as a CEO?
Yeah, no, that's a great question. So I'm very much like you. So for example, we were running a rig, obviously when the pandemic hit in March. We had just set intermediate casing on a 2-well pad. We stopped and convinced the rig company to stack the rig on our location to avoid, mob and demob charges. We told them, we said, look, we will pick this rig back up, and we're probably going to be the first to do it. So they worked with us, and I'm grateful to that. We ended up picking up our rig in August, partly because oil prices had rallied back above 40, and really we need about 35, 36 to be economic in the Turner and Shannon. And I had these ducks sitting there, so I wanted to go ahead and finish them off. So we're finishing out our 2020 program now. We'll actually let the rig go. We'll TD our next well, final well, in about 2 weeks, and then we're done for the year. So to your point, I have been surprised to see, in particular, the Permian, rigs still running down there. I'm not surprised to see people using the DUC inventory in order to work it down and kind of hold their production flat. I kind of get that. It's an IRR game, and obviously they got a lot of sunk capital sitting there. But I am surprised that the rigs are still running at 30. Anything with a $3, $35, $36, $37, $38, $39 a barrel. Why are you running a rig, right? I mean, that doesn't make sense to me. So we, if oil prices dip again, we don't plan on picking up a rig until we see, a 4 back in front of it, kind of 40 to 45. One thing that's really important, though, that I'm glad to hear other CEOs talking about, production growth is not the driver anymore, right? It's all about generating positive results. Now, everybody talks about free cash flow, and we'll generate free cash flow too. There's a little dirty secret, though, right? Our industry, look, when you look at the declines of all these wells, right? You look at the shale wells and how fast they decline. You can't generate free cash flow in perpetuity. It just can't be done. So we will have to, at some point, go back to drilling, but maybe not as fast. And I hope we don't go back to where we were. But, will we be back to 300 or 400 rigs running? Sure, absolutely. That has to happen. Oil prices will rise over time. With a new administration in, and typically we do better under Democratic administrations, right? They'll put more regulations on us. That tends to make oil prices go up. And so, we'll be fine. This industry is resilient. We will get through this. But I do think we've got to be judicious. We do have to earn Wall Street's respect again. And that does mean living within our means. Not enough companies do that. And I think, ultimately they're going to suffer, right? Those companies will be punished if they continue to just run rigs for production growth. I've always said flat production is not a bad thing, right? I if you can hold your production flat, that's just maintenance capital, and do it properly and be able to kind of live within your means. It's all about your capital structure. I'm always amazed when I see companies just let their capital structure get out of whack. It's just, we're in a commodity cycle business. Prices will go up and they'll come back down at some point.
Well, it seems that there is a benefit. In the energy business, notwithstanding access to capital, but I would argue now that the industry is sort of 2.2% of the S&P, it doesn't get any attention, and generalists don't care. And if you miss 100% rally, you've probably influenced 0.75 basis points on your overall performance, and it's just easier to own Amazon. I'm curious, as you look at the world in the next 3 years, could you see more companies being private and sort of doing as you guys did, where you don't have to do the quarterly reporting, you don't have to satisfy a larger base, you just need to return positive net income to your shareholders and do what's right for the business in the cycle? Do you see that as the trend that will come out of this? So we won't bring investors back publicly, but we may have some private family offices or what have you that have a value slant?
Absolutely. Look, I've run several public companies, and there's nothing wrong with being public in and of itself. But, the reason to be public is access the cheapest form of capital, right? Well, unfortunately today, just to your point, when we're 2.2% of the S&P, generalists don't care about us anymore. There's really no value in being a publicly traded company. Look, I've run, Eagle Rock was a public company. I ran Rome Resources last year, which was a public company. The cost of being public is $5 to $7 million minimum. Okay, when people talk about $3 to $4 million, that's not right. It's $5 to $7 million minimum to be a public company. So unless there's a real benefit to it, scale. That's the other thing I would argue. To be public, you had better be $5 to $10 billion market cap, right? Anything smaller than that, people don't care about you anymore, right? You're not going to get analyst attention, and you definitely are not going to get the generalist attention. So I agree with you that I think you'll see more companies go private because you don't have that burden of the public markets, and you don't have that scrutiny of the quarterly earnings calls and all that. I run Samson like a public company, though, meaning I give my investors, they're all private, I give them quarterly updates just like a public company would. I give them, financials. Now, I don't do the full MD&A, and, I give them what they need, and I host a call every single quarter for them, and I talk about what we've done and where we're going as a company, so they have transparency. They love that. And I think you'll see more of that. And that allows us to make what, as I said earlier, public companies make decisions that add quarterly earnings. Private companies make decisions that add long-term value. And I really think you'll see more private companies come out of this mess, which is not a bad thing. Now, at some point, there'll be a reason to go public again, right? There will be, the markets will reopen to us. And then, at that point, you can either go, public debt, which is fine, or you take your equity out.
Well, I like the threshold that you put there is you really need to be a $5 billion plus company. And if you go on the RBC website, which is always my favorite morning check, see where everyone's at, the number of companies above 2 billion has shrunk by about half this year. Mm-hmm. And then when you take Concho out and when you take WPX out and when you take some of these other candidates that have merged out, you're left with very few. But there's social issues around a management team in the twilight of their career, or even, they might be mid-40s and they have a great paying job and their management team has access to benefits, etc. Making that decision to merge for the benefit of shareholders, but to the detriment of the management team is a very hard one. And I think that it's been part of the reason we've seen such slow change. And where we have seen changes, I had Clay Gaspar on the show a couple weeks ago, and Clay will be taking over as COO of Devon. Tim Leach with Concho is taking over as senior VP. So we're seeing these more mixed teams, which solve some of that. Do you think that the mixed team is going to be an ongoing theme in acquisitions? And as a leader yourself, how would you look at an incoming management team and figure out what's the best to balance the culture you had and the culture you want and the people you have, and how you upskill that in a quick and decisive way?
Yeah, that's a great question, David. Well, like I said, I've been doing this, 39 years. I've probably done close to $25 billion of M&A in my career. I've integrated a lot of companies, and it's not easy. It's very difficult. Probably for the first time, maybe since '86, we have to out of necessity, right? Mergers and acquisitions have been a luxury probably for the past 20 years. Now it's a little bit of a necessity, right? We kind of have to do it. So you have to get over that my baby is prettier than your baby from a valuation standpoint. The harder part is exactly what you said, right? Which team is going to run it, and those are difficult. And then you have to worry about the cultures themselves, right? I have a lot of respect for Clay and Rick Moncrief here in Tulsa and what they've done with WPX. I have a lot of respect for Devon. I have a lot of friends over there. I think it's going to be interesting to see the melding of the two cultures. Obviously, by putting Rick and Clay as, the number one and number two guy, you kind of know, it's going to be more of the WPX culture, even though, we'll see how many of the WPX people actually make the, transition to Oklahoma City. But I think you're going to see more of it, and it's out of necessity that we have to do it. One of the things that I think is a little interesting dynamic that, quite frankly, I have not seen in my career. So yes, in my career, I've seen equity markets come and go. Yes, I've seen the debt markets come and go, meaning, our industry's been in and out of favor over the past, 40 years in those two markets. What I haven't seen, though, and this may be the first in the past 40 years, is the bank market is not there for us, right? So the banks have always been there for us. I think even in '86, most of the banks were still there lending to our industry. This is the first time that the bank groups are really withdrawing from lending to us. I'll give you an example. A good banking friend of mine told me 1 year ago, we had close to 46 banks, international and domestic banks, that were lending to our industry, meaning new money. Today, it's probably 15 to less than 20 banks are willing to lend to our industry, and that's new commitments. So that's a game changer. And so again, I come back to the need and necessity, right? We're a capital intensive industry. We need access to capital. When the banks aren't willing to loan to us, then you kind of, it becomes survival, right? And so I do think this consolidation wave is necessary. As to the cultures, that's going to be interesting. I'm a big believer that, look, we as management are here for one reason and one reason only, and that's to generate positive results for our shareholders, right? If we're not doing that, then we shouldn't be running that company. Anything other than that, right? I know there's a lot of guys like their perks, the private planes and all that. They kind of need to get over it. Those days are kind of over. And so it's all about showing your investors that you are the most capable in running that company. There'll be winners and losers out of this, and we'll see. We'll see.
Well, it's interesting because, I mean, we talked about Devon and WPX. And so as we think about acquisitions and mergers and my baby's prettier than yours, you're in a basin that has generally had relatively few public entrants. And as a private equity backed company in 2016, when people would ask, have you guys looked at the powder? The general answer was no, because we couldn't see a public company in the, acquire and flip model that would allow us an exit. And certainly post 2018, we've seen a drill your returns model, which can either be public or private. How do you think about the consolidation in the Powder River Basin with guys like yourself, like Rebellion, like Wald, like Peak, who I know Jack Vaughn very well from our Enterplus Peak 1 or Peak 2 days? How do you think that works? And then how does that overlay with guys like EOG and Devon and Oxy, who have big positions there, which will transition after this answer to talking about the federal government and federal lands in Wyoming. But first, how do you see privates and publics and private equity? How do they put that puzzle together to have one or two big operators in the Powder River Basin?
That is an excellent question, and one that we talk about every single day. So it's no secret, when I was hired to turn Samson around, it was never to rebuild Samson into its former glory, right? Ultimately, my investors want a return. They want to eventually exit. So that's not a secret. And we were on our path to exit this year. In fact, as the pandemic hit, we were in the middle of a data room and bids were due March 14th. And, as fate would have it, we ended up shutting the process down. Now, we've continued to talk to a lot of would-be buyers. There's still a lot of interest because, relative to the Permian, obviously the cost of entry is much lower in the Powder than it would be in the Permian. And I'll come to the federal lands because that is weighing on us right now. But
For sure.
So, again, and you are right. That's probably what's hurt the Powder is that we don't have a pure play public company that's waving the banner. EOG has been a big player, but it's kind of second or third, really third on their list. And they got the Permian, they got the Eagle Ford, and then the Powder is third on their list. Devon, same story. Obviously, it's all about the Permian now. Oxy, post Anadarko, that's how they got in. Clearly, they have their own set of challenges, and so the Powder ranks fairly low. Chesapeake was by far the most visible. Unfortunately, we know they're going through their own set of challenges, but they certainly were waving the banner for the Powder River Basin. So I do think, and we have definitely talked about now, given where we are, being the consolidator of the smaller players in the basin. There needs to be a consolidator. At one point we thought EOG or Devon, and they looked like they were going to be the consolidator. Clearly, I don't see that happening now. I'll be candid. I'm not so sure Devon wouldn't at some point exit the basin. I mean, given now with the WPX and their laser being focused on the Permian, which makes perfect sense. Chesapeake, same answer. A lot will depend on the bankruptcy. We'll see whether or not they end up staying in the Powder or exiting. Oxy, same answer. I could see them potentially monetizing the Powder. I think they'd like it. I think they really like what they see. But at some point, I could see them potentially monetizing it. So the basin is kind of ripe for consolidation. It's also ripe for a new entrant that may be too gassy or is in areas that they've kind of depleted their own inventory and they need to refresh their inventory. And there's a lot of public companies that I could think of that fit in that category. And certainly some of them were talking to us because we'd be a great, we're kind of a nice bite-sized entry point for somebody, a strategic. So I think, given what's happened, I do think you will see some consolidation in the basin amongst the privates. I have a lot of respect for what Rebellion has done and Wald and Northwoods and Impact, but there's too many of us running around that are probably stretched too thin. A little bit of the challenge there is that each is backed by a different PE firm, and so the social issues of how you bring those companies in, with various large PE-backed sponsors is always a challenge, but one that, we certainly are looking at, and I think it needs to happen.
When you talk about the federal lands, because that's clearly a drag, just in terms of being unclear. And I had Ellen Wald on the show last week, and we talked about what Biden actually meant by his fracking ban, not fracking ban, federal land, not federal land. And I know that there is some complexity, which is why you need really good attorneys to be able to break out like what exactly the federal government can do. But as you look at a Biden administration, assuming that he becomes the president, how do you think that federal land and fracking on federal land and permits on federal land are going to be impacted for you in particular?
Yeah, great question. Well, so certainly one that's kept me awake at night. I can promise you that.
I bet. As an investor in some federal land in New Mexico, I feel the same. I feel the same burden.
Here's good. There's good news and there's bad news. And so I'll start with, I have always preached the benefits of being on federal lands, right? The ability, low royalty rates, right? So we have very high NRIs, which really helps our economics. The ability to form federal units and be able to, hold large amounts of acreage and develop it in a proper, orderly fashion. So the benefits are enormous of operating on federal land. So, I'm a big fan of federal lands. Now, yes, a Biden administration and really the progressives, the wanting to ban fracking. And so I guess I'll start with, I don't think that they'll go that far. I think a lot of it was rhetoric for the election. I think Biden is smart enough to realize that, he's taken over in the middle of a pandemic. Job creation is going to still be job number one for him. Killing our industry makes zero sense, right? At the end of the day, he does not need to kill our industry. Quote, banning fracking is not going to happen. Now, could they impede permitting on federal lands? Sure. Now, we and EOG and Devon and others, and we've all been public about it, we have ramped up our permitting process. So right now, we're on pace to have close to 100 federal permits in place by the end of this year. So with one rig running continuously, that is 8 years of drilling inventory that we have. So we feel like that will help kind of mitigate a potential slowdown in the federal permit process. If they were to go so far as to banning fracking on federal lands, well, obviously, the state of Wyoming is not going to take that line down, right? Neither is the state of New Mexico. Neither is the state of Colorado. I mean, that is really going to affect those states' bottom lines in terms of both their job, the workforce, their ad valorem severance taxes. I mean, that is a big deal. So I think you'll see a lot of litigation that will come out of that. To me, that's almost akin to a taking. So again, we certainly will get behind IPAA and others in terms of, defending our legal positions. You hate to get there, but that could end up happening. I just don't see Biden quite going that far. I know he's got to appease some of the progressive in his party, but I also think he's got to balance it that he needs job creation, and he knows that we're still one of the largest job creator industries. So I'm optimistic that they won't quite go that far, but we're prepared. I mean, obviously we'll do what we have to do to defend ourselves. By getting the permits in place, we feel like that's certainly going to mitigate a ban or a slowdown on permits. But an outright ban on fracking, then that's we'll have to deal with it when it comes.
I like your perspective to really put it in from the amount of revenue that states generate, and Wyoming is a huge oil and gas producing state. Colorado, same thing. New Mexico, same thing. And the tax revenue supports so much beyond what we do. And I saw from the EIA this morning that for the second year in a row, CO2 emissions in the United States dropped, in large part because there's been more coal to natural gas switching that has reduced the reliance on coal and increased the reliance on natural gas, which I think is a net positive for those who are concerned about climate change. Last question for you. If you could go back to your younger self, let's say it's 2001, 2002, and you could give yourself some advice that would really help accelerate your career, and you could share that with some of the younger folks that are listening to this, what would you say, and what do you think that what you would say would change your career for the better?
Yeah, so that's a really, really great question, David. What I would say, and I do tell this to young people, or really even people of my generation. Look, change is inevitable. All right. If we don't adapt to change, we become dinosaurs. So yes, these are the fun factor right now is kind of low, but I have been successful in my career because I've adapted to change fairly quickly. Um, B, I'm also a big believer that when one door closes, another one will open. But it's up to you to open that door to see what's behind the door. I see so many people, get laid off and they think it's the end of the world. And the truth is, it's a new opportunity. Kind of to your point. So exactly during that time frame, 2001, 2002, I was a senior officer inside of El Paso Energy, and large company, and we had world domination on our mind, and it was fun. Enron then happens. Obviously, the world blows up. It's a whole different game. I ended up leaving El Paso, not because they asked me to. I felt like it was time for me to go do something different, and I wanted to start my own company. And I ended up going to Blackstone Minerals, which was a great opportunity, and really enjoyed it. It was a great opportunity to go from a really, really large company to a really small company and help them build up, which really then enabled me to eventually start my own company, which ultimately it became a public with Eagle Walk. Best thing I ever did. And at the time, I would have told you that I was very happy staying at El Paso. I wanted to eventually run the company. But it was the best thing that ever happened to me. It was one door closed and another one open, and I chose to open that door. And I never looked back on it, never absolutely looked back on it. The other thing I'll say is, for all the press that our industry is going to go away and electrical cars are going to dominate the roads, and I always have to point out to people, look, people have been professing the end of our industry over the past 30, 40, 50 years, one way or another, right? We were either going to run out of oil and gas, and now, of course, demand is going to come crashing down. The good news is, as I look out my window in Tulsa and I'm looking at I-44, there's a lot of cars out there, and I can tell you that one out of 100 may be an electrical car. Our industry is still a critical part of the fabric of our society, absolutely critical part of the fabric. So yes, today is not a whole lot of fun, but times will get better. We just have to be better stewards of the capital and of the environment. That to me has been the wake-up call out of this whole thing. And it's not a bad thing. We just need to be better stewards of the capital and of the environment. And if we do those two things, our industry will come roaring back. America needs us. The world needs us. I am not worried one bit that our industry is going to, see some sunset. That's not going to happen. So to the young kids today, I always tell them, look, wait, give us a year. It'll be a whole different story a year from now. Who would have thought a year ago, kind of to what you said earlier when you let off, when 2020 started, obviously, and there was, the assassination of the Iranian general, oil was $60 a barrel. We all thought, man, this is going to be a great year. Well, wait 2 or 3 months and look what happened, right? And it's a whole different. We will survive this. We are a resilient industry. I'm really proud of what we do. We're going to be fine. We really are. But we just got to be better stewards of the capital and better stewards of the environment.
Well, I love your passion. I love your energy. I love all the experience you've brought. And I hope for the CEOs who are listening that they take a little lesson on the hedging and the spacing, because hedging and spacing is the best two ways that you can control stewarding your capital. And those that make bad mistakes on that find themselves at the bottom of the barrel. So, Joe, thanks so much for joining us. I really appreciated the conversation and getting to know you and value your time.
Thank you, David. I really enjoyed it. Thank you very much.
Awesome. Until next time, be safe, be good, have a great day.